All right, let's get right into it. Today, we're taking a magnifying glass to Celestica that its electronic manufacturing services peers. We're going to apply a rigorous Warren Buffett-style value analysis to this whole space. The goal for this explainer is actually pretty simple. We want to combine a rock-solid qualitative assessment of the business with strict quantitative valuation models to see if we can actually find a true margin of safety here.
You know, Peter Lynch really hit the nail on the head when he said, insiders might sell their shares for any number of reasons, but they buy them for only one. They think the price will rise. When we look at Celestica right out of the gate, CEO Rob Mionis directly holds over 1 million shares. That is serious skin in the game, and it tells us that leadership's interests are heavily aligned with ours as potential long-term shareholders.
Okay, so here's our roadmap for today. We'll outline the companies analyzed, assess the businesses and their moats, dive deep into the financials, run our valuation models, define that crucial margin of safety, and finally, deliver our verdict. Section 0, Companies Analyzed, Setting the Stage. Just to be completely transparent, we are keeping this strictly by the book. We're relying entirely on the uploaded filings, specifically the 2025 annual reports, Q1 2026 earnings data, and the Q1 2026 Lincoln International EMS review. Our primary target today is Celestica, and we'll be benchmarking it directly against its core competitors, Flex, Jabal, Sanmina, and USI. Moving to Section 1, Business and Moat Comparison, the Buffett checklist. Because remember, we don't just want good numbers. We are hunting for a truly wonderful business. So what exactly is Celestica doing right now? Well, they've pulled off a pretty massive pivot. They transitioned away from traditional lower-margin electronics assembly and into what's called a joint design and manufacture, or JDM model. Basically, they are now this high-value engineering partner heavily integrated with major hyperscalers. They're building the critical data center infrastructure needed for AI and machine learning compute. It's a totally different ballgame. And that pivot totally changes the moat comparison across the industry. Celestica's new model creates proprietary intellectual property. Their hardware platform solutions literally allow customers to get to market 30% faster. That creates massive switching costs, which gives them a narrow to wide moat. Contrast that with giants like Flex and Jabal. They rely mostly on scale and cost advantages, which is fine, but we'd rate that as a narrow moat. And then there's Sanmina, sitting at none to narrow, since they're still heavily reliant on those traditional EMS contracts. So if we run Celestica through the classic Buffett checklist, the results are honestly pretty incredible. Is the business understandable? Yeah, absolutely. Do they have a durable competitive advantage? For sure. Just look at their 98% on-time delivery rate during severe chip shortages. Are they generating consistent high returns? Well, a 2025 GAAP return on invested capital of 41.6% screams yes. And finally, able and honest management is clear through their excellent capital allocation, highlighted by their recent launch of a program to repurchase 5% of their public float. Let's jump into Section 2, Deep Financial Comparison, by the numbers. Now, a really interesting dynamic emerges when we stack Celestica's balance sheet up against its competitors. Jabal and Flex are pulling in massive top-line revenues, $32.6 billion and $26.8 billion, respectively. But Celestica punches way above its weight class in profitability, boasting a diluted EPS of $7.16. Plus, they only have about $746 million in long-term debt. Flex and Jabal are sitting on nearly $2 billion and $2.6 billion. One quick caveat. Our provided source documents were missing the free cash flow data for the peers, but we'll address how we handle that in a minute. And just look at this revenue trajectory. It's absolutely staggering. They hit 28% year-over-year growth in 2025, reaching $12.39 billion. This is not some fluke. It is driven directly by their connectivity and cloud solutions segment, which is just vacuuming up all that demand from the immense hyperscaler build-outs for AI data centers. All right, Section 3, Valuation Models, Intrinsic Value Testing. Because as we all know, a wonderful business is only a wonderful investment if purchased at a sensible price. Let's walk through our actual valuation inputs for Celestica. For our discounted cash flow model, we're anchoring our base free cash flow on management's 2026 outlook of $500 million. Then we apply a very conservative terminal perpetual growth rate of 2%. And for the Graham formula, we're plugging in that 1016 adjusted EPS estimate for 2026. Quick pause here. To nail down the Graham intrinsic value formula perfectly, we actually need the current AAA corporate bond yield. Since the source filings didn't hand that to us, we are going to temporarily plug in a 4% yield for today's base case just to keep the analysis moving forward.
Now, this is wild. Anchoring our multiples analysis, this graph straight from the annual report shows Celestica's explosive cumulative total shareholder return since 2023. The stock has completely crushed both the S&P TSX and the S&P 500 Information Technology Index. But as value investors, looking at a chart like this immediately triggers a crucial question. Is all this good news and then some already priced in?
Well, when we look at the multiples, the answer starts to look like a massive yes. Celestica is currently trading at a PE ratio of 46. That's more than double its own 5-year average. And looking at enterprise value to EBITDA, Celestica is at almost 26 times, while peers like Flex and Jabil are sitting comfortably around 12 times. Celestica is trading at an absolute premium. I do need to point out a slight gap in the source documents we're working with regarding those peer free cash flow forecasts. Without the specific 5 to 10-year forecasts for Flex, Jabil, and Sanmina, doing a true cross-board comparative DCF is a little tricky, which forces us to rely heavier on relative multiples for the peers in this case. Section 4. Margin of safety. Defining the buy price. You know our golden rule as value investors. We aggregate all our intrinsic value outputs, and we demand a strict 30% discount, a real margin of safety below that calculated base value before we ever authorize a buy. It's our absolute shield against estimation errors and unpredictable macroeconomic shocks. So, bringing it all together, the verdict is crystal clear. With Celestica trading around $372 a share, our margin of safety is literally negative. While the business quality is phenomenal, if you reverse engineer the DCF, it reveals that the current stock price implies a completely unrealistic perpetual growth rate. It is just overvalued. Meanwhile, based on the data we have, peers like Flex and Sanmina appear much closer to fair or undervalued opportunities. And that brings us to Section 5, Final Verdict, the Committee Pitch. When we balance business quality against current valuation metrics, here is how they rank. We put Jabil first, strong operations and a very sensible 12x multiple. Flex is a close second. Celestica, despite undoubtedly having the best business quality and the widest moat in the AI space right now, drops to third simply because it is priced for absolute perfection. Sanmina and USI bring up the rear due to weaker moats and margins overall. So what's the bottom line? Is Celestica a wonderful business? Absolutely. But is it selling at a sensible price? No. Our final recommendation for strict value investors is that Celestica is a clear hold if you already own it, or a pass if you are looking to deploy new capital. The current price offers zero margin of safety, despite their truly incredible fundamentals. Let's wrap up this explainer with one final thought to chew on. At what price does an exceptional AI infrastructure leader turn into a dangerous value trap? It's literally the hardest lesson in investing, learning to separate a great company from a great stock price. Keep an eye on Celestica, let the hype cool off a bit, and wait for your pitch. Until next time, stay focused.